Hello and greetings and welcome to the next video in our series here at the Expat Teacher Network. We want to start, as always, with our two important reminders. One is to remind viewers and members that this video is part of a series, and this is installment number 5. And we'll be touching on and mentioning topics that we've covered in the first 4 videos, which, if you haven't seen it, could make things a little bit confusing. So, our advice, please watch the videos in order. It'll make your life a lot easier. Second thing is to remember that we are not certified financial planners or advisors. We don't claim to be experts of any kind. We're not interested in giving individual investment advice. That should be done in conjunction with your financial advisor and on your own, based on your own experience, okay? So, getting right to it. Video number 5 is titled, With a Little Help from My Friends. No, not just because we're fans of the Beatles music, although that's true too, but because our main topic today is talking about financial advisors and how you can pick a good one, and more importantly, do you even need one? Could financial planning be a do-it-yourself project? Well, let's get right into it. First thing is to make people aware of a very basic conflict of interest that exists between most financial planners and their clients. Most financial planners and financial advisors, the people sitting across from you at your kitchen table that are trying to sell you mutual funds, or if you're not from North America, you call them unit trusts. They're trying to sell you the kind of funds that we call managed funds. You remember our previous video, managed versus index funds, and why index funds are so much more advantageous for investors. Well, the truth is that these CFA, CFP people, they don't want to sell you index funds. And the reason is very simple. The managed funds earn them much greater commissions. They earn virtually no commissions from index funds. And so therefore, they push the managed funds. In fact, it's possible that people like me, for example, go well over 10 years of owning mutual funds and don't even know that index funds exists. I didn't know they even existed until I bought and read Andrew Hallam's book, Millionaire Teacher. And thank goodness I did. I'm a lot smarter now. Well, what this means at the end of the day is that your financial planner is doing what's in his or her best interest and not what's in your best interest. They're looking out for themselves, not for you. Okay, it's only partly their fault. They're not responsible for the commissions being what they are, and they're selling the products that earn them the greatest amount of money. Why? Because they got a family to feed like everybody else, and they're trying to earn a living. However, from your point of view as an individual investor, you need to do what's best for you. So this begs the question, are there objective financial advisors? Are there financial advisors that will put your interests first, or where this conflict of interest doesn't really happen? And the good answer is yes, there are. They're maybe a little bit more difficult to find, but they're out there. And the way they basically work, the difference is that the objective financial advisors, instead of making their money from commissions and charging no extra fees. That's the way most financial advisors work, right? You never write them a check. You just buy the funds that they sell you and you sign on the dotted line, and that's it. Objective financial advisors, however, will have you sign on the dotted line to buy index funds, but then they'll also charge you a fee instead of taking those commissions. However, what this means is that the products they're offering you, they're not offering you based on higher commissions. They're not pushing high commission products for their own benefit. They're offering you the products that are of most benefit to you. And so therefore, there is no conflict of interest. We've got a couple of websites there that we've mentioned. Objective Financial Planning, that's Jason Heath. He operates out of Markham, Ontario, which is near Toronto. He's more specifically geared towards Canadians, obviously. rwinvestmentstrategies.com is, if I'm not mistaken, it's in California. It's in the United States, I know that for sure. I'm pretty sure it's in California. And again, they operate on a person-to-person basis as well. The last two that we have there, Vanguard.com and BlackRock iShares. Vanguard is in the United States. And you can have a personal account with Vanguard, and they will put a person in touch with you. My sense of it is I don't have an account with Vanguard myself because I'm not an American. I do own Vanguard index funds, but I buy them through my US brokerage account using ETFs. So you don't actually need an account with Vanguard to buy Vanguard products necessarily. BlackRock, they're all over the world. They really are a company that is everywhere, and the best advice I can give you is get on their website, put in, what country you live in, and then it'll steer you in the right direction. The only downside to that is if, for example, if you live in France and you put in France, it will change to the French language website. So you'll need to be at least halfway functional in the language of the country you're living in. But the way that these financial advisors work is, instead of earning their money from commissions, they charge fees. And sometimes, I know in the case of Jason Heath, if I'm not mistaken, he'll charge up to $4,500 Canadian dollars. And that seems like a lot of money, but it's actually not if you compare it with the fees that are hidden from you that you will be paying over time if you've bought managed funds. I promise you, the $4,500 at the end of the road will seem like chump change. And what's also true is that a lot of these objective financial advisors, they work on percentages. So if you don't make a lot of money, if the markets, if what they put your money into doesn't do very well in a given year, you end up paying less. So it sort of motivates them to choose wisely and choose correctly. Okay, so let's talk about, well, I've got the person sitting at my kitchen table. I don't know them from Adam, and I don't know if they're an objective financial planner or if they're somebody that's going to push managed funds on me, and I don't know what I should, what's what and what I should ask. So here are 6 questions that we basically took out of Andrew Hallam's book, Millionaire Teacher, and we sort of boiled them down a bit. And it might have been his other book, to be perfectly honest. I'm not sure which one, but we got them from Andrew Hallam anyway. We kind of boiled them down a bit and added some other questions from an article that we found on Forbes.com. And we boiled it down into these 6 questions that if it were me, this is what I would ask. And the first thing I would ask is very simple. Do you invest only in low-cost index funds or ETFs? And if the person says, no, I don't invest in index funds at all, then I know right away this is not the person for me. I know right away that conflict of interest that we mentioned at the beginning of the video, whoop, there it is. And so I need to move on and find another person. And the second way I can find out if this person is right for me is I'm going to ask them, how do you earn your money? Do you earn your money from commissions, or do you earn your money from separate fees that you're going to charge me? If this person says to me, I earn my money from commissions, well, that tells me right away there's only one product that this person is going to be offering me, and that's managed unit trusts or managed mutual funds, and I'm not interested in that. And the third question is really designed to test the knowledge of the person sitting across the table from you. The truth is, I don't want to be investing my money with somebody who knows as much or less than I do. They need to know a whole lot more than I do. Otherwise, why would I engage them? And I need to test whether or not they fall into the same traps that a lot of financial advisors and a lot of investors fall into. And the question that's easiest is, can experts predict where stocks are headed? Can you predict in the next 15 years which mutual funds are going to be the great winners and the ones that are going to outstrip the market, or the ones that are going to be the big losers? Because frankly, according to multiple Nobel Prize-winning economists and according to some of the most successful investors ever, and I'm talking people like Warren Buffett and John Bogle here, they all say no. John Bogle very clearly says, I don't know what the market's going to do, and I don't know anybody that knows. I don't even know anybody that can predict the market. Some people can maybe get lucky. Frankly, if you go into the casino and you're at the roulette table and you're betting on red or black, you might even win 5 or 6 times in a row if you're really lucky. I don't, but some people I'm sure do. But sooner or later, your luck is going to run out, because in situations like that, in the end, the house always wins. Everybody knows that. And a fourth question that's a really good one to ask is, can I see a model financial planner portfolio? Not a real one with somebody's name on it. That would be betraying a confidence. But if you're going to sell me a plan or build a portfolio for me, what would it look like? What do other portfolios that you've built for other people look like? Give me an example. And that's a very easy way for me to figure out, is this person going to be putting me into index funds or not? It's another way to answer other important questions like, does this person understand that I need a balance of stock index funds and bond index funds to give me diversity and security? Do they get that, or don't they? If they don't, then I'm better off with somebody else. Question 5, it's a little more aggressive, but it's equally important, is to look at this person and say, how do you invest your money? What have you put your money into? And if they're not willing to tell you and not willing to share that information, then, well, you got to ask yourself why. And maybe it's better if you move on. And the one that can take them aback perhaps more than all of the others is to simply ask them, what are your credentials? The truth is, in the early 1990s, I started working for Primerica Financial Services. I didn't last very long with them, and I sat across the kitchen table from people and gave the spiel. Now, granted, I was never the only one there, but how much did I have in the way of credentials? A big fat zero. Nothing. I had never passed any insurance exams. I had never passed any exams or taken any courses. I'd never spent more than 5 minutes in some sort of environment where I was training to be a financial planner. I had no professional qualifications at all. Now, the person sitting next to me did, but what they had, frankly, wasn't a whole lot more than my zero. In many cases, it was only a matter of a 2-week or a 3-week course, and then they passed an exam, and there they were. They were ready to be a financial planner. There was certainly nothing like any sort of extended intensive academic study into finance or economics or anything that would maybe be relevant. Okay, so having said all that, what we do want to make people aware of is that financial advisors, especially if you have your money with them already and you want to switch to index funds, the way that they'll try to talk you out of it, and they will, because don't forget, they're earning those big fat commissions on the managed funds, is they'll apply pressure and they'll use scare tactics. And what we want to do with part of this video today is to make you aware of some of the most common scare tactics and pressure tactic arguments, and then to give you some of the best rebuttals for those arguments so that you can defend yourself, and also so that, frankly, you just have a better idea of what's going on. So some of the arguments that financial planners will use, the most often heard one, I think, is that, index funds are too dependent on the overall market. Index funds will only give you an average return. And if you stick with me, because, I'm a professional and our company, we only offer the best products, and we only offer those products that beat the index funds, right? You can't beat the market with an index fund on your own, because the index fund will just do whatever the market does. But our fund managers, these guys are sharp. They'll actually make you tons of money. And you're only going to be sold the best funds, because I would only ever sell you the best. And the reason that we're better than the index funds is that our fund managers are so clever. They can time the market. They can jump in and out of the market before the big crashes come, and they can get out before the big peaks come. And basically the main argument is that they're better than the market itself, that they know better than the market. The problem with this is, when we look at the actual data, is that this isn't true. So here's one of the best ways to counter these scare tactics. It simply is a matter of asking questions that might seem to be a bit aggressive, but they're really not. And the first one is to simply ask the financial advisor, what recent calendar year saw the biggest decline? And they should say 2008. If they don't, then the person you're with is really bad. One of my financial advisors that I've been victimized through over the years probably wouldn't know the answer to that question, frankly, and I don't have any money with him anymore, and guess why? And he only ever had me in actively managed mutual funds, unfortunately. So when they say 2008, you say, okay, did most actively managed mutual funds beat the market that year? If we look at all the mutual funds that could be sold to any random person, and we look at the ones that beat the market that year and the ones that didn't beat the market that year, where does the majority of actively managed mutual funds fall? On the upside or the downside? And the interesting thing is, if you look at the Standard & Poor's 2009 study, because they did study this, the vast majority of managed funds are on the downside. They did worse than their appropriate index. So if you've got a fund that is invested in stocks on the New York Stock Exchange, they actually performed worse than a simple New York Stock Exchange index fund. And what does this mean? Well, it's very simple. It means that those fund managers that your financial advisor says can time the market, they didn't, or they couldn't. That great crash that came in 2008, they didn't see it coming, or they couldn't see it coming. And either way, it's bad. And they didn't get out in time. And this happened to me with my account. One of my accounts, I lost about 50%. And the reason is very simple. I didn't have my money invested in index funds, and I didn't have any money invested in bonds, which would have minimized my loss. And I certainly wouldn't have lost the 50% that I did lose. And what's also true to remember is this. between index funds and managed funds, if they each make the same, if we have a managed fund that makes the same rate of profit, the same rate of return as the index fund, you as the investor don't actually see that, because there'll be percentages up to 1.5%. Remember our previous videos, that's taken away in all sorts of commissions and fees. The fund managers are very highly paid. There's the 12B1 fees. Oh, and don't forget, actively managed funds have a much greater rate of turnover, right? They're buying and selling much more often. Every time they make a gain, the tax man shows up. Capital gains tax reduces the amount of profit that ends up in the investor's individual pocket. An index fund has virtually no turnover in a given year, and so if the market makes 10, 12%, 8%, whatever, that's what you as the investor get, more or less, minus a little bit. And so the actively managed mutual fund, even the ones that are doing a little bit better than the index, and the ones that would make the financial advisor go, aha, see, it does better. Well, no, not really. It would be true if everybody in the chain of an actively managed mutual fund was willing to work for free. That is, the fund manager, the company that sells the funds, the tax people, i.e. the government, and most importantly, your financial advisor. If he or she were willing to forego all of their commissions, then yes, what they're saying would be true for some, not all, actively managed unit trusts or mutual funds. So if things get heated between you and your financial advisor, if the guy or the person is really starting to look, they're starting to sweat a little bit, they're starting to look a little like, uh-oh, here's one that you can really throw at them if they get a little bit aggressive. It's a bit mean-spirited, but it is true, is to simply say to them, show me your portfolio from 15 years ago. Let's compare your personal portfolio from 15 years ago with the actively managed mutual funds that you say I should buy today. And if all of the funds that you're trying to sell me today were in your portfolio 15 years ago, then I'll consider investing with you. Well, trust me, you'll probably run into a brick wall on that one. I've never known any financial advisor that was willing to open their own portfolio, because most of them that would do so would probably never work as financial advisors again, because people would see how poorly they themselves have done. And look, the bottom line is this. In terms of finance and in making money, and in making money in the market, the person sitting at your kitchen table, they're at the bottom of the totem pole. They're at the bottom of the food chain, not the top. The top is the hedge fund managers and the pension fund managers, people that are handling billions of dollars in assets, people that have a long proven track record of doing this and doing it well. The bottom line is, if your financial advisor were really that good at this, he or she would be a hedge fund manager or a pension fund manager. And they're not. And that's why they're sitting in front of you. And combine that with, as I say, in many jurisdictions, I know in my own country of Canada, to become a financial planner or advisor at a bank, you basically need a 2 or 3 week seminar. That's it. And in some cases, the people before the 2 or 3 week seminar, if they're willing to come clean with you and you ask them, how much about finance did you know before the 2 or 3 week seminar? Some of them will even say, nothing. I didn't know anything. I don't know about you. I don't want to invest my money with people like that. I don't want to invest my money with people that have only 2 or 3 weeks worth of knowledge, because frankly, if you've done some reading, if you've read Andrew Hallam's books, which are available on Amazon, you can even get to them through our website at expatteachernetwork.com. Don't forget that. Just click on the pictures. It'll take you right to the Amazon page for both of his books, the one on global expat investing and Millionaire Teacher. If you've read those books, you're probably better informed than a lot of the people who have the words financial planner or advisor on their business cards. Certainly that's would be my humble personal opinion. And that brings me to one of the main points of this video today, and one of the reasons why we really wanted to include this video in the Expat Teacher Network series is to simply ask this question: why not do it yourself? You can do it. I have colleagues I know, and there are a lot of people like this, where anything financial scares them and it stresses them. I have friends, they say, oh no, I can't handle this. I don't even want to think about it. It's too difficult. The minute I start to think about it, it makes me feel like my head's going to explode. Well, then isn't it easier to just do it yourself and to do it very simply? You simply open your own brokerage account. It's the same as opening a bank account, frankly, and in fact, most of them are done through banks. And then you become your own financial planner. In his books on global expat investing and millionaire teacher, Andrew Hallam has multiple versions, especially in his second book on global expat investing. He has multiple versions of sample portfolios, even broken down by, do you live in Australia, or are you Australian and an expatriate, or are you an American expatriate, and are you here living here, and da-da-da. He breaks it all down for you. And there's one that I personally found really good because it sort of suited my lifestyle most. It was called the couch potato portfolio. I love that name. And it basically just says build a portfolio using two basic items: stock index funds and bond index funds. Now we'll go into exactly, a little more detail on all of this stuff in later videos, but for now, that's what you need to know: stock index funds and bond index funds. And the rule of thumb is how much of it should be in bonds and how much should be in stocks. Well, the percentage that should be in bonds, because that's the more secure part. Bonds don't tend to react to market fluctuations the way stocks do, obviously, right? They're much more secure. So the percentage of bonds should roughly equal your age. If you're in your 30s, your split should be about 30% bonds, 70% stocks. And of course, the more you have in stocks, in some sense, the more aggressive your fund is. But that's a good rule of thumb. And then every year, or maybe twice a year, you do what's called rebalancing. If you're supposed to have 30% in bonds and 70% in stocks, you have a look at your account at the end of the year. Is it still 70-30, or maybe have those bonds crept up a little bit because stocks haven't done so well? If they have, sell a little bit of the bonds and buy a little bit more of the stocks. Have the stocks crept up? Is it now like down to 80-20 because the stock market's done really well? Well, then sell off some of those stocks and buy some more bonds with it. And why do you do this? Because when you do this, it's basically forcing you to sell the component of your portfolio that's worth more. So it's kind of forcing buy low, sell high down your throat a little bit. Remember in our last video, we talked about everybody knows buy low, sell high, and hardly anybody does it. Well, by doing this rebalancing act, if you want to call it that, it causes you to sort of by default buy lower and sell higher. And okay, maybe you won't make great gains necessarily by doing that, but it will force you to sell the more expensive item of the two. And by doing that, you can't help but win. And it's very simple. And it takes like 10-15 minutes out of your life in a year. I think even people that get stressed by finances could manage that. And so it's one question that I throw out there for discussion. I throw it out there because I think it's one that needs to be answered. Why not do it yourself? I admit I don't really have a financial planner anymore. I just do it myself. Yes, I like watching the markets and I'm interested in it, and I'm going to talk in our next video. We're going to start talking about investment strategies if you're the sort of person that really does like to play around a little bit, and how much you should invest in that and what you can do, some strategies to minimize your risk. Those are for later videos. But all we're really saying today is, if you're going to have a financial advisor, choose very carefully and ask the right questions, but really consider this a do-it-yourself project, because there's no reason why it can't be. Teachers, you're all educated and intelligent people. You can do this. You can do this. You don't need help. You simply need to know some basic principles and get on with it. Well, okay, now getting on with it means you've got to know, where should I open my brokerage account? We've got some suggestions here up on the screen here that we've taken from Andrew Hallam's books. We've split it into those of you that are U.S. citizens and those of you that are not. The one to mention there is the TD Direct Investing International. That's for those of you that are from Canada, that is the TD that we know. That's Toronto Dominion Bank. But that particular one there is headquartered in Luxembourg. And if you're an EU resident like myself, the advantages of Luxembourg, it used to be like the offshore tax-free zone, but it's really not that anymore. As of January 1st, 2015, Luxembourg has signed the magic contract where they've said, we promise we will share all details of all bank accounts with EU member governments. So if you're living in Spain or France or Italy or Germany and hoping to put your money in Luxembourg to keep it away from the tax man, it won't work. In fact, in my case, I just keep my German brokerage account because the commissions at TD Direct are significantly higher than the commissions at my low-cost online brokerage here in Germany. And so even though the taxes are higher, because I don't do very much trading, or don't do very much buying and selling, it's easier and cheaper for me to actually just leave my money where it is in my own home country. Okay, that's it for with a little help from my friends. Hopefully we've locked you into some good information there that you can latch onto. There's our list of sources, Andrew Hallam's 2 books. As I say, remember, you can get to them right through our website, expatteachernetwork.com. Please don't forget to subscribe to our YouTube channel and to come join us on our Facebook page. Just search for Expat Teacher Network. We promise we'll approve you. The more members we have, the stronger we are, and the more people that we can educate and help. And we look forward to seeing you next time, and thanks for watching.